Just as you come to the podium, we'll turn it over to you, but I'd like you to, all of you, to join me at the podium to receive the Fund Grade A+ Award for the Tradex Global Fund, earned in 2014 for risk-adjusted performance, which is less than 4% of Canadian mutual funds earned. So, this is an award. Let me just say it's an award for top performance for the Global Equity Fund. Thank you very much.
Well, thank you. Good evening, everybody. Great to be here again to talk about the Tradex Global Equity Fund. And obviously, we're very excited for the award, but we like to look forward. So the aim will be to get it again. So, Tradex Global Equity Fund. Just a little bit about the strategy that we employ in investing your money. It is a value-oriented investment strategy, similar to the last speaker. He likened it to trying to buy a Lexus. I'm not quite sure what the make of the car he was trying to buy, but for the price of a cheap car. I like to think of our strategy as we're kind of going to the grocery store and we're looking at we need to buy our groceries, but we're looking to buy what's on sale. So we're looking to buy the cheap stuff. And how we do this is we invest in closed-end funds. And closed-end funds are like mutual funds, much like Tradex, the various Tradex funds, but they trade on stock exchanges and they can trade at either discounts or premiums to their underlying net worth. And what we try to do is buy the funds that trade at discounts to their underlying net worth. But what you result in this strategy is a very diversified portfolio of equity exposure, and so there shouldn't be a lot of surprises from one particular security not doing well. You should be pretty insulated from that, and if we do our job, we should make additional money from the underlying equity exposure from taking advantage of these discounts over time. City of London is a London-based headquartered company, but we do have offices around the world. I'm based in our Philadelphia office. We also have an office in Singapore and Dubai. And our specialty is closed-end funds. So we manage lots of different strategies using these closed-end funds, both fixed income, multi-asset class, and equity, like the Tradex Global Equity Fund. There's 29 investment professionals there, so we do have a lot of coverage of our investment universe and what goes on in these closed-end funds. Our investment process really is a combination of top-down. That just means we kind of look at the macro environment and the market valuations, and we combine that, combine our view based on those macro factors with bottom-up stock picking of these closed-end funds. That means meeting with the closed-end fund investment managers, which are typically household investment management companies, BlackRock, PIMCO, Fidelity, JP Morgan, those types of companies. And we look for the ones which are trading at attractive valuations and that we think are good managers who can do a good job in their particular market. Why are closed-end funds a good place to invest? In any investment strategy, what you want to invest in is an area where there's market inefficiency. And that's really the case with closed-end funds. And the reason is because most closed-end funds are sold to individual investors, and what happens over time is that most of the investors in this universe of securities are not discount sensitive. Typically it's flow sensitive, so that as investors come into a particular strategy, say their wealth manager, the wealth manager will have an approved list of closed-end funds. they will buy those closed-end funds irrespective of whatever valuation they're on. And so that really creates the opportunity for a more discount-sensitive actor, and the size of the relative actors, the discount-insensitive actors are much larger than the discount-insensitive actors. So that performance over 2015, and we need to kind of enlarge this a little bit, but 2015 we outperformed the benchmark marginally with a return of 11.8 versus benchmark 11.66, and obviously good, strong year for equity investors, particularly if you're a Canadian investor. So good returns, and that's obviously net of the expenses in the fund. In terms of how do we generate that performance, we've got the rolling attribution at the bottom table, and this is the rolling year to March 31st. We break this out between the different components. Country allocation, we are marginally positive. Currency movements, we lost money, and that's basically because we didn't have enough dollar exposure. NAV performances also did not do that well. We'll get into that a little bit later. And then discount movements, we added some value. So performance drivers over the last year. As I mentioned, discount trading is what our kind of specialist bread and butter is, and that added to returns in the fund. What we've seen as stock markets around the world have become quite volatile over this year, and that has increased the volatility of the discount movements within our closed-end fund. So it's a good environment to be a closed-end fund investor when that occurs. And what that means is that in this type of environment, we have much more of an active trading mentality to capture these discount movements. And also, what it also means is we do make a little bit more use of exchange-traded funds, where, say, for example, one of our closed-end funds becomes expensive, but we want to maintain exposure, then we might buy an exchange-traded fund for that purpose, until we find another opportunity, and then we'll switch back out. So discount trading has been helpful. Event-driven positions, I'll kind of get into a little bit more, but these are idiosyncratic returns from closed-end funds, which are unique to the closed-end fund universe. NAV performances overall, we didn't do too well, but there are certain areas where we did get good performances from our managers, and that was mainly in European large caps and also Japanese large cap funds. We also made money from opportunistic exposure to the US REIT sector. There's a number of closed-end funds which specialize in that area. This was a sector of the market that got particularly beaten up in late 2013 with the rumors of the first rumors of Fed rate hikes, and as a result, discounts widened. We thought it was an attractive entry point, and that came to bear in 2014 with strong performance from the REITs. The other area that did particularly well, we've had the position for a number of years, is private equity fund of funds. These are funds which have very diversified exposure to unquoted or unlisted companies that then get either sold or have an initial public offering on the stock market, and that realizes gains for these funds. So they've done very well. In NAV terms, they've done pretty well, but they've done extremely well in terms of discounts narrowing over time. Detractors has been our country and currency allocation. For some years, we've been stubbornly underweight US equities, which has not been a good call. So that has hurt us, and that's really a relative value. We think there's better value elsewhere, and that has not come to bear, particularly last year with the US dollar strength, also aided US equity returns. We have had some out of benchmark exposure to emerging markets, which was basically neutral because the good returns from some of the Asian markets was offset by poorer returns from Brazil and Russia. US closed-end fund, net asset value performance, these are funds that invest in the US equity market, did not do very well, they did not outperform the S&P, and so that hurt returns. And we really see this, the US equity market is a very efficient, lots of investors in that space, so not a lot of opportunity to get an information edge in that market, and so very few managers are able to outperform. Monk's Investment Trust is a special situation where we had a large position in the fund, had done very well. The manager went through a period of underperformance, and in actual fact, we met with the board of directors of this fund, and they met with other shareholders as well, and they've actually subsequently replaced the manager. So we're hoping for better returns from that investment. And then finally, we had some exposure to the resource sector, which obviously at the end of 2014 and 2015 didn't do too well with the oil price declines. In terms of these event-driven positions, these are situations within closed-end funds which help realize that discount value. And these are things like tender offers, where you will say you buy a fund at, say, a 12 discount, they have a tender offer, and maybe you'll be able to realize 25% of your position at net asset value. So effectively, you're making that 10 percentage points on that 25% of the position. Similarly, rights offerings within closed-end funds often offer opportunities because the pricing is attractive and not all of the shareholders participate, which means that what we try to do is oversubscribe in those situations, which allows us to pick up more than our proportional share of stock. Oftentimes, you'll see after a rights offering, the discount narrows once it's completed. Capital gains distributions work out similarly to tender offers. US closed-end funds have to distribute their realized capital gains, and so we look for those funds where markets have risen, there's been some turnover, and we expect some realized capital gains. And then finally, manager changes. This is where an announcement of a manager change in a particular closed-end fund often results in some instability. Sometimes it results in some shareholders being false sellers. Again, that's a temporary situation which can result in some pricing anomalies and enable us to take advantage. Gabelli Equity Trust is just one of those rights offerings, and as you can see, the green line here basically shows the discount, and that big drop is the period of the rights offering. And as you can see, so with the pricing became very attractive in terms of buying securities via this rights offering, but subsequent to that, we had over a 5% narrowing in that discount. So this is a general US equity fund where effectively this rights offering, you're able to make 500 basis points over the benchmark just through the idiosyncrasies of closed-end funds. And then finally, private equity fund of funds. This shows some of the performance there. The bottom right-hand chart shows the discount narrowing that we've had in these funds, which have been additive to the returns. On the other charts, the blue line is the net asset value performance, the red line is the index, and so they effectively match the index, but because of the discount narrowing, that's generated outperformance. So, markets, how do they do? well, they did pretty well, as we've seen. The MSCI World Index over the last year was up nearly 20%, and so that has been very, very good for international investors. You can see how that's broken out. US and Japan outperformed, European markets lagged somewhat, and that's a lot to do with currencies because the euro was weak last year, so even though those stock markets did well locally, if you're a euro-based investor, if you're a US or a Canadian investor, a lot of those gains were eroded because of the currency. And I think what we're kind of looking at here is that, you know, if you look at the returns over the last few years, you've done very well from global stock markets, and I think that what you have to wonder is whether, as these markets do well, whether you're borrowing returns from future years, and that's something that we're a little bit concerned about. Valuations get a little bit more advanced. The bottom chart just shows the performance of the Canadian dollar. Obviously, it was weak versus the US dollar, but did make some gains against some of the other currencies. And obviously, as an investor, you want to be investing in those markets where you have an appreciating currency. In terms of the global environment where we see things right now, we think that, as the last speaker said, you know, we think we're in a very much low growth environment. We don't really see a lot of pickup in growth. There certainly has been some better than expected economic data from the European markets, but this is really just kind of shifting a little bit. You know, we've had a very strong US dollar, which I think will weigh on the US market. But in general, there's just a lack of demand within the global economy. And that's a lot of that's due to the fact that we have had, in previous years, growth driven by this kind of debt super cycle, where credit is really driving the growth, coupled with some productivity gains. But now it's whether what is going to drive it, because debt burdens within the world are pretty high. So we don't really see any signs of a strong pickup in growth. We expect inflation to remain low and wage pressures to remain low. Obviously, there's a lot of talk about the Federal Reserve in the US raising interest rates, and that remains to be seen. Obviously, we've had weak data. US GDP came out pretty weak. That may be weather related, it may not be. Bond yields, as the last speaker said, offer little compensation for bearing credit risk. In a lot of these corporate bonds, we've seen their spreads narrow, and obviously commodity prices have been pretty weak with the global growth environment. So where does this leave us? Basically, we think that there's not a lot of clear areas where there's good value within global equity markets. You know, over long periods, the stock markets are driven by earnings growth, and earnings growth can only really grow as fast as the economies are growing themselves. So we've had pretty good returns over the last few years, in excess of what we've had in terms of nominal growth. So that just makes you wonder whether that can continue for a long period of time. Effectively, what's happening is the valuation multiples are going up on the stock markets. So we think over the next year that equity markets will be, the way this will work out is they will be volatile and pretty much range bound. We won't make a lot more gains. And so we have that kind of trading approach to the markets. In terms of the various region outlook, US we continue to think is relatively expensive. We think it hasn't been helped by or the environment hasn't been helped by the strength in the US dollar. Given that European and Japan central banks are embracing their quantitative easing programs, we think that there is going to be a bias towards a continuing strength of the dollar. Doesn't mean it's going to get a lot stronger, but it probably isn't going to get a lot weaker. Europe, we've seen some equity market rebound. We think that in the core markets, Germany, France, that markets no longer really offer compelling value that they did a year ago, but there is some value in some of the periphery markets. The UK is an area where we think there is some value right now. They have an election coming up on May 7th that has resulted in some relative weakness there, and from a valuation point of view, we think it's a pretty cheap way to get exposure to a lot of the global companies that are listed there. Japan has been a focus and has done very well over the last year, but really there hasn't been a lot of improvement in the long-term economic dynamics within that market. What there has been and what there is in play is some kind of technical factors which are helping the market. It's the quantitative easing program. It's also the fact that their government pension fund is investing more in equities. And also, we are seeing some improvement in corporate governance, more shareholder-friendly policies, and also share buybacks. So valuations on the whole are probably as cheap as anywhere in Japan, but we have seen some gains already. Canada or Australia, we just kind of said the same thing, but in Canada, the US links and the Canadian dollar weakness will help. The commodity sector is kind of a wild card. We think it'll be a tradable area of the market. Australia, similar situation, but replace US with China and Asia. Obviously, Australian dollar strength is supportive. And then in emerging markets, so it's widely diverging, and when I read this, I thought it should be wildly diverging. But we've basically seen strong markets in Asia, but relative weakness in Latin America and Eastern Europe. Eastern Europe, obviously, with the Russia-Ukraine situation not being too helpful. We think there's pockets of value in emerging markets, but not the great opportunities that there were. And what we do like about emerging markets is they're very much unloved. And when markets are unloved and no one's got a good word to say about them, that can often be a time that you want to invest in. So in terms of our country allocation, just to summarise, we are overweight to the UK at the moment. We also have an overweight to Canada, overweight to emerging markets, and also some of the Scandinavian countries, Sweden and Norway. Norway is very much an energy type economy, and so that's kind of leaning against that weakness in the oil price. Japan we have as a neutral, and US underweight. Eurozone is underweight, and as is Australia, which we have been for some time. In terms of these weightings in this type of market environment, they will be quite changeable, we think, because as some markets outperforming, we think the Eurozone is still reasonably attractive, but it has had a good run, so we're more inclined to take our exposure from the UK right now and have the Eurozone take a back seat, but that may change going forward. So that kind of summarises the approach. Obviously, very much look at this value-oriented, provides a diversified portfolio, and our view is that markets can be fairly range-bound, but there's going to be good opportunities for trading around these allocations to where the relative valuations are at any given point in time. So that's my comments. I'm happy to take any questions. Yes, look back.
You or do you look down in this area?
That's a very good question. I think as I've been over here longer, I've kind of migrated. I'm kind of mid-Atlantic right now, so I don't know whether that makes me closer to London, Ontario, or London, England. I think people over here think I'm closer to London, England, but my family in England think I'm closer to London, Ontario.
He wants to know where the company's based.
Oh, I'm sorry. Company's based in London, England. Yeah.
So you mentioned that based on the manager is supposed to pick up the best valuation for stock. Considering the number of variables that we have, don't you use it with supercomputers to choose the right composition?
We don't use a supercomputer. There are obviously a lot of variables in equity markets, and what we try to do is one, be diversified and not try to bet the house or make very large bets on one particular market. But what we try to do is invest with the balance of probabilities. So if valuations are cheap, if earnings growth we think is strong and the economy is doing well, then those are all kind of check boxes in the plus side.